What's up, YouTube? It's Joe Catchpolia sitting on the couch, making some money, investing in fractional real estate online, as usual. I feel like the overprotective dad sometimes who's constantly telling people, hey, don't do that, you're going to get hurt. What are you thinking? I'm having these feelings again when I'm looking at the discussion that's happening in the Garden Gate Discord over on Lofty. If you're not familiar with this, the discussion I want to have is about, proper risk management, how entities are typically structured in real estate investing, and really more broadly in business and private equity, the structures that are used. But I'm going to use Garden Gate as an example. I don't this is absolutely has nothing to do with this specific deal. I've been in and out of this property a few times, but I don't own any right now, so I don't have any vested interest in what they actually decide. But I just like to, whenever I see that I think that we're going in a bad direction on Lofty, and I think really objectively it is, when we do certain things, I like to just bring it up and mention, like, I think that there's certain risks, there's certain things that we're not, thinking about. And I just, especially when now they're talking about, oh, we're going to do this and it's going to be a great example and we're going to roll it out in other DAOs. It really just worries me. And so I'm going to get into the structure of how investment companies typically set their deals up, why I think it's important, how it applies to what we're doing on Lofty, and then at the end I also am going to do a little bit of math specifically around Gardens Gates um, financing transaction too, because I think there's some mistakes being made there, but we'll see. Just first of all, I want to make sure this is one episode or whatever where I'm going to talk about a lot of like legal structures and um, risk management and finance type stuff. And I want to make sure it's clear. I'm not giving you legal advice. This is not financial advice. I'm going to talk about my experience, the stuff that I've seen, um, and what I think are best practices in the industry, right? But this is not to be applied to a specific situation, right? I think a lot of this is something that people really should be consulting their own financial advisors, CPAs, and attorneys for some of this stuff. But okay, so what are they doing, and then how is this, a broader issue? They want to take out a loan because this property is owned free and clear. Take out a loan, use that cash, buy crypto with it, buy Bitcoin specifically, and in their situation, they're going to dollar cost average over a certain period of time. Um, I want to make sure it's really clear. This is not a Bitcoin hating video. This is for the purposes of what I'm talking about. We can assume Bitcoin's an amazing investment. That putting their money into Bitcoin makes perfect sense, and that's what you should do. It doesn't change anything that I'm about to talk about, right? Like no matter how good of an investment Bitcoin is, and actually, the better you think it is, the more you shouldn't be structuring things the way that we're talking about here. Um, and so let's get into it. And then at the end, I am going to, like I said, I'm going to do a little bit of math about like uh, the loan and this and the investing over time and whatnot. But so, okay, what's the best practice? Like, what do people normally do if you see REITs, if you see private equity groups, if you see funds, or even just how I've had my own personal real estate holdings set up? This is one of the most common things that you see. You have a real estate holding, the parent company, and this has a number of investors involved in it. And then underneath this company, you have individual LLCs that own, specific properties, right? This is Land Bank Holding, Farmland Holdings, and it says, okay, this has 200 acres of soybean farm, this has a multifamily complex, this has a commercial building. This entity has 100% ownership, and they note on this, and this is just one that I pulled online, and mentioned that it's 100% risk. Um, there's actually this is a pretty good article on business risk by an attorney here in Texas, although he seems to be no longer taking on new clients. But he talks about like structuring and this is, I mean, so I've looked at literally hundreds of these org charts because when I used to work in lending, every time a commercial entity applies for a loan, they give you a org chart. Something like this is what I think is really normal to see. His article is mostly about um, series LLCs. Don't get too hung up on that. In Texas, our series LLC it's we basically have the equivalent protection, and again, not legal advice, but of individual. It could be Series A. It's just like saying LLC one, LLC two, LLC three. I mean, it's essentially the same thing. Um, but so this is like the most common structure setup where you've got your you have your investing and ownership vehicle, right? That doesn't own any properties directly and doesn't do any business directly. It owns separate LLCs, and each one of these LLCs will own a property and their operating accounts, right? They might have their reserves, but there'll be nothing else in these LLCs. And then in addition to that, so that's this setup. But in addition to that, a lot of people set up this separate operating company. That this is the company that's going to deal with tenants, contractors, professional services. A lot of times, people they'll set this up in sort of what they call a shell situation, where um, it takes possession of these properties and it operates them, but it doesn't have any ownership in them, right? And so, if any of these people decide to sue, they don't necessarily get access to the equity of these things. But anyway, this is sort of the more complex version. This is when I've done my own properties, I just have stuck here, right, where I have multiple entities, each one owning a single property. So this is why I want to just get into why this is really important. Well, okay, and first think about when we're looking at Lofty, we're sitting at this level, and each property, each DAO is like oh, one of these individual entities, right? And so maybe your Lofty account is in your personal name and not in an LLC. And maybe it's a good idea to talk to your attorney or your CPA or for financial advisor and find out, should you be using an LLC as your investment company, on these platforms. Are you going to do that in your personal name or there? But if you look at, when you're talking about like these Bitcoin treasury companies, if they operated in the world of these of real estate operating companies, they wouldn't be holding it here unless maybe it's just in their reserve. Typically, your treasury funds are going to be at this level. This is the level above the DAO. This is us as individual owners in the DAO, right? And so that's what I think is lost on a lot of people. That this structure is just so burned into my brain. Like it's how just everybody operates, and there's an important reason for it. And there's a couple. So there's one, yes, in this, and okay, and one thing that maybe I didn't want to have too convoluted of a thing, but you can have multiple entities have ownership in this LLC, right? Don't let that throw you off, right? Because there's multiple of us that are owning the DAOs. It doesn't really matter, right? We're just owning a piece of that property, but we still should be operating in this area. Again, just my opinion, not financial advice there. I'm going to give you a lot of that today because this stuff makes me a little bit nervous to talk about, partially because in the short time I was an attorney, I did a lot of this setting up entities for people. And this sort of advice, um, I think that it is, so it really borders on that. And I want to just make sure I'm not talking about your specific situation. You want to just look into that. Um, I do think even more though, I saw this way more in lending because every time we looked at deals, we'd always ask for their org chart. We want to know. So, on the commercial side, each one of these entities is what they call a SPE or SPV. It's a single purpose entity or single purpose vehicle. It's usually bankruptcy remote. It in the loan docs themselves, it says, or in the entity docs themselves, it says the only thing we can own is real estate in cash or cash equivalents in FF&E, right? So we can't buy anything else, and that's like just standard operating procedure. Um, because so okay, this is where all the business risk happens, right? I mean, unless we're using this other model where we're outsourcing it, even then, when you have a property that it becomes a lawsuit target. Like one of the things a lot of people say in this industry is, you're not really a real estate investor until you've been, hit with your first frivolous lawsuit. Like I've been sued over just dumb stuff, and I've seen people get sued over even dumber stuff. And so, like it's because there's a big pot of gold there, right? Like attorneys don't take on suits if there's not some prize at the end of it, right? If there's not some way to actually get to cash, they don't like to take on those suits, right? And so this is where the risk happens. This is where the business happens. This is where the interaction, the tenants and the liability. It's also where our debts occur, right? This is where we have our mortgage. And so the goal as we accumulate assets is to get them out of this entity as quickly as possible. Because as long as they sit in this entity, that's cash that's at risk, right? It's at risk of a lawsuit. It's at risk of the property going bad and not being able to pay the mortgage and getting foreclosed and, oh, getting a deficiency judgment and they come after our cash afterwards. A lot of people don't realize that, right? Foreclosure isn't the only option that lenders have. If you're typically, if there's a guarantee on that promissory note and the property doesn't cover it, and this is again not all the time. It depends on your state. It depends on your loan docs. But very often they could come after the other assets of this entity. And so what's being proposed is we start to accumulate a lot of assets in this entity. Um, and there's some discussion of, yeah, if and that's what I'm saying. Like the better the investment that Bitcoin is, the more risky this strategy is, right? Because you're just all you're doing is you're taking something that's not a risk asset, right? As far as holding Bitcoin, you're never going to get sued for holding Bitcoin. You're not operating any sort of business. And so what you're doing is you're keeping that risk inside of an entity that has business risk. And it's so and that's why these are set up this way typically is because you do take money out and you move it up into this company, and this is where the individual decisions and allocations are made. And again, remember, in the analogy to Lofty, this is our individual Lofty accounts, right? This is why whenever we're trying to do stuff inside the DAOs, the risk averse person in me is just going crazy because there's just no good reason for it, right? Especially when it's something like buying Bitcoin. We could take this cash, send it up to the individuals, and those individuals could buy Bitcoin. It doesn't, the Bitcoin doesn't appreciate any faster in the DAO than it does in our own hands. Um, the other thing too, if we're only, if we're taking a big lump sum, but we're only dollar cost averaging it, most of us with that cash in our hands would do something with it where it's making more than the 4%, interest rate that we're getting in the meantime, and then could allocate it later on. Um, but this is something like even like if you look at private equity companies, they hold their portfolio companies like this too, and they will very often take out new loans, take all that cash out of the entity, and then it's just the business's job to pay down the loan again, and then when they can, they do it again. And so if we want to use these these real estate holdings as a means to get to cash, uh, the goal should be to funnel the cash out of the DAOs and into this point as quickly as possible. And so, yeah, if you want to have a Bitcoin treasury company, you should set one up and that holds the DAO assets, right? Like that's how I see this. You certainly don't want to start to accumulate a lot of assets that are completely passive, non-business risk assets inside of an entity that has this operating risk. I mean, that's the main reason that you see this structure. I mean, you'll have, REITs or funds or just individuals like me will have a ton of LLCs and put one property in each and never hold anything, have a bank account that has the operating funds, maybe a reserve, but never have anything else. And so, are you going to put some of your reserves in Bitcoin? I think that's a different discussion, right? And it's one I'm going to ignore for now. Just the argument against it would be, well, it's it fluctuates wildly, right? And so I don't necessarily want to be a forced seller if I need that cash right now, right? So I don't think keeping too large a portion of your reserves in it makes a lot of sense. But I think there's a healthy debate that could be had about that that is separate from, okay, now that we're talking about funds that are over and above our reserve amount, should those be held in the entity? And I mean, I think if you talk to anybody that's done any sort of entity structuring, that's worked with holding companies and investment companies, I don't think there's anybody out there who would say, "Oh no, it's a good idea. Let's start to accumulate accumulate a lot of assets in these operating entities, because that's what these are. These are the entities that hold the business risk. They hold the property. That's where the liability is. That's where we like to fund, get our debt. And so that's all that creation of risk there. And so once we start to pull cash out, there's just no good reason to leave it in here. So this same discussion can apply to when we're doing Bitcoin in there, whether we're trying to make loans inside the entity, right? No, we move that cash out and let people make the loan. Now, a lot of people are not going to make the loan, or it's going to be too small of a piece, and that's a separate problem. But the more different assets you start to keep in this, especially if some of them are creating other business risk, it just creates a lot of problems there. And that's why I actually am somewhat embarrassed that it took me this long to be able to articulate this well, because I think that this is why it's so obviously wrong to me when we're doing all these different things in the DAO, because your risk stops, right? You're not moving your risk up. But so like when we're doing more and more investments, we're basically like creating more stuff down here, instead of so you want your capital to move up past your risk, your risk line basically. Um, and now there are, I don't want to make it sound like, oh, that's just a perfect world. There are some instances where, like, if you just moved out too much capital and then this thing imploded, well, yeah, there's some ways that people can go after that capital after the fact. But, and I think that, oh, I wanted to mention this though. I think some people are thinking, well, if we started to have a problem, we'd just move the crypto out of there. And no, you can't do that. Then that could actually be something that could potentially be clawed back in a lawsuit. You can't just deplete all the assets of an entity once you've accumulated that liability, right? Like if you've moved your stuff out, ahead of time and you haven't left this entity underfunded, then it's a much different task to be able to do that. So in general, that's why I think it makes very little sense to hold stuff here. You just want to move it up to here, right? Up to the holding company. It also, oh, then there's some business reasons for this too, right? The other reason they do this is so when they're allocating capital, it can get reinvested optimally, right? If you leave money in this entity and then this property, something comes up to where it makes sense to just let this entity die, right? Let that property go. But you've left all this cash in there. Well, then you're going to, it's just going to get reinvested because the creditors of this entity are going to have access to it. Where if you move it up here, it makes it easier for you to prune your portfolio. And this is part of having you're not going to have all winners, right? One of the things that really drags down a lot of investors is trying to make every deal a winner. If you're willing to just keep throwing good money after bad or bad money, I should look that up because I screw that up in everyone. But anyway, if you're always putting more money in on a deal that is just a loser, you eventually drag down your whole portfolio that way. Where when you have these isolated properties in an isolated entity, if something goes really wrong, you just let that die. You've already taken profits over the last several years. And on average, when you go to reinvest, you can either put that money, into capital projects on a property that really needs it, or by investing into new properties, right? So that's why, like, just from both a risk and business perspective, it makes very little sense to operate inside the DAOs. Uh, in addition to that, well, let me just make sure, because some of this stuff. Oh, and so yeah, the other thing you're doing by doing it with crypto, like this is one of the things, people used to always say, like, not your crypto, or not your keys, not your crypto, something like that. Um, you're adding, so let's say the Bitcoin, that is the best possible investment, right? But now we've got it down here in the DAO. We're adding so many layers of risk on top of our Bitcoin, right? So now okay, the whatever exchange we're on, we already have some risk, right? Like if people don't want to keep it on Coinbase, like there's different places, no matter where you keep it, there's some risk there. But now we're adding another layer. We have a custodian, right? In this particular scenario, it's going to, the proposal is to have Alec do it. It's not that I don't trust him. I think that he has good intentions and everything. but it's another layer of risk. It's another place where things can go wrong. And he said, oh, and he's acknowledged that and said, look, I'll sign some legal documents that says, that holds me accountable. Well, I mean, that's a good acknowledgement that there is risk there. But then, okay, if there is some issue, we have to be able to enforce that legal document, right? And then, even if we can, if something has happened with that Bitcoin, we also need him to be solvent, right? If we're going after him, as that's who signed the document. And then you have the layer of risk of the DAO, and there's a couple layers there, right? You've got the DAO governance votes, right, which we've all seen can just go in crazy directions sometimes. We've seen recently on Colfax, like owners just making what I think are just kind of absurd or just maybe uneducated decisions when they're voting. Maybe they just didn't know all the facts or whatever it is. But so you have the governance risk in the DAO, but then you also have the business risk, which is what I was just talking about a bunch, right? You have something could happen at that property, could lead to a lawsuit, could exceed your limit to liability on insurance, or possibly your insurance lapse for whatever reason it is. Then they have assets in the DAO that so your crypto is then exposed to business risk. If you just moved the cash up here and everybody held their crypto individually, you'd be getting rid of three layers of risk in you holding that. Um, in addition to that, you're losing control of the timing and allocation of it, right? And so, okay, the vote is to dollar cost average, but then people are discussing like, well, I'd also like to be able to buy some dips. Um, there's all these different reasons where maybe having a programmatic setup might not be the best decision, right? Or might um, so as far as timing goes, but also as far as allocation, if it continues to grow in a DAO that you hold, but you also hold crypto in other places, or you hold it in other DAOs, right? If other DAOs start to do this, you start to lose control of your ability to properly allocate, right? I mean, the reason you're investing on Lofty is you're trying to get some real estate exposure. You probably also have Bitcoin exposure somewhere else. Well, if some of the DAOs start to get really Bitcoin heavy because you've had a bull market and it starts to be too high, it's very difficult to balance now because you have both stuck in the same entity, right? And if you're, depend a lot of times allocation depends on your risk profile, your age, how close you are to retirement. And so the chance of the DAO having the perfect allocation that matches what you're doing is zero, right? I mean, so maybe one person it's very close to zero, right? Like the fact that all the other people are going to have different risk preferences, different time horizons than you. And so and yeah, the tying thing as you're just tying two different types of assets together in a way that you don't need to. Like you should, if I'm going to hold crypto, I want to hold it in somewhere that is not at risk because of some unrelated investment that I'm doing, right? And so I think that's what's going on there. Let's see. Best practice, entity structure. Oh, dilutive. Oh, okay. And so now I want to actually just talk a little bit about the debt specifically for Garden Gate, um, and why I think like the way we're approaching this capital, the capitalization of this, the looking at the stack doesn't make a lot of sense. So the proposal we're talking about somewhere between 50 and 70% LTV. I did my math just at 60, assuming it's around $300,000 property, $180,000 in debt. And then, okay, they talked about, okay, let's allocate about $150 a day. That ends up being about 4,500 a month. Um, it takes over 3 years that basically allocates 162,000, and then they had also talked about putting some additional cash in the reserve, and so I think that makes sense. But the math of like what's left over and how much they borrowed and whatnot. But there's a couple of things that I think make this an extremely inefficient transaction. Um, the first is this is dilutive debt. So if you remember, I did a video a couple weeks ago about accretive and dilutive debt. And what do I mean by that? So anytime uh, my cap rate, and for this, our average yield and our cap rate is very similar. Does he actually give me a cap rate on here? Oh, there we go. Yeah. Anytime I was looking like right above it too. Let me just move that. So anytime that our interest rate is higher than our cap rate, we have what's called dilutive debt, right? Like this property is not really covering that debt at a rate, okay, we're borrowing 60% because it can't afford the full amount, right? And so anytime that your debt is dilutive, it doesn't make sense to take out debt to invest elsewhere. It's a much more efficient use of your capital to sell this property and then use the proceeds of that to invest in whatever you're trying to, I'd never take 7% debt on a 4 or 5 cap property. Like it doesn't. I mean, that's just like uh, the only reason that you'd ever do that is if you think that this property is just going to appreciate at a very high rate, right? Like sometimes people will use dilutive debt. They'll take a negative cash flow, and this is not a negative cash flow, and you can have dilutive debt without it being negative, right? And the point is like your cash on cash return goes down from this versus up for the property itself. So that's the first point, right? I think it's sort of absurd to use 7% debt, and maybe it's only going to be 6.5. I mean, whatever it is, but to use debt that's significantly higher than your average yield, significantly higher than your cap rate, is just, it's very much against best practices. It just doesn't make from a pure finance perspective, it's something that you just don't do it. It's a very inefficient use of capital. Selling the property, taking that cash and investing it in whatever you want to use the funds that you take the loan out is what I would do. I mean, I would never buy this property and use a mortgage to buy it when the cap rate is so far below the current interest rate. And it's why you see a lot less investors buying today. Um, it's why on Mogul you see them only, use short-term rentals and pad splits today because those properties have significantly higher cap rates for similar prices. Which reminds me, please like and subscribe. In the description to this video, I have links to all of the platforms that I'm investing in, Mogul being one of them. It's the one that is my current favorite. But do your own due diligence on all of those platforms and all the properties. Just because I say something is or isn't a good deal doesn't mean that you should invest in it or not. You should dig into it yourself. Your risk preference and time, horizon and everything like that's probably different than mine. And there's also a link to my Discord that I have set up where you can jump in there. There's like 110 of us now. It's just fractional real estate investing discussions in general about a whole bunch of different platforms. So please feel free to do that. Um, yeah, so I was just saying, that's why Mogul is using those different business models so that they can use debt that is accretive, right? Because they have a much higher cap rate than their current interest rate. But it's why you see most of the smarter long-term rental investors not buying today or buying much less. It's because as those rates are, they outpace cap rates, it makes very little sense to buy. Okay, so that aside, right? I mean, that's a separate issue. But I think like if you're going to try to get capital from this property and you can't do it in an efficient manner, meaning you can't do it at an interest rate that's lower than the cap rate, but you really want to use this property to have that capital to invest, the right answer is to sell it and to take that cash and use it elsewhere, right? Um, and I mean, sometimes I know I come across as like too like I do believe there are right answers in some of this stuff. There's sometimes it's a what's best for you situation, and then sometimes it's just like a pure math, like this is actually the answer, unless we're making some wild assumptions again about like how this particular property is going to appreciate or something like that. Um, which may be right. I mean, it's a very low cap rate property. It is a pretty nice home in a nice area. They tend to appreciate better. For the most part, most real estate investors would never buy this property. The only ones that would do it if they had some reason to believe this particular property was going to appreciate faster than the market. But in general, when you have, the more expensive your property is, the nicer your property is, the less likely it is to make good financial sense from a cash on cash perspective, which is why you see a lot of, sometimes though investors take that to the extreme and they chase the worst properties in the worst markets, and then that hurts them because they don't realize that, over the long run, they're going to get no appreciation. They're going to have like bigger problems. But anyway, that's a weird aside. I'm sorry about that. Um, but so okay, what was I doing over here? I'm looking at okay, we have a $180,000 loan. Um, we're allocating 4,500 a month to Bitcoin. That's about $150 a day. This is sort of what they're talking about. So all I'm doing is looking at the idle cash at the end of each period, right? And applying the current interest rate to it. Now you notice this number goes down much faster than how much the interest portion of your mortgage payment goes down, because that's not what I'm looking at. I'm assuming the money that you put into Bitcoin, you're happy with the return that you're getting compared to the 7% interest rate that you're paying on it, right? Let's say that makes perfect sense. So we ignore that. We're just looking at our idle cash, right? And so when we look at this deal, in the first year, and I'm saying, okay, we have a 7% mortgage and we can reinvest the money at around 4% in some cash equivalent. Um, in the first year, we lose $4,500. Uh, and over the full 3 years of this, just the loss on the interest arbitrage on the cash that's sitting there is $8,700. So what does that mean? Does it mean it's a bad idea to put that money into Bitcoin? No, that's not what I'm saying. Um, either, right? And is it a bad idea to go real slow with it? I'm not sure of the answer to that, right? But I think if I were structuring this, and if I thought that 4,500 a month was the right number, what I would do is I would figure out, okay, what's the loan amount that lets me put out 4,500 for a year, right? So okay, I need to borrow about $60,000 or maybe 70, right? Because we want to put some of that extra cash um, to the side. We're beefing up the operating reserve. Why would I do that? Well, one, we're in an environment where I think rates are more likely to go down than they are up. They could go up, but I think they're more likely to go down. And so if I'm going to, if I want to a year from now refinance and take more cash out, I could do that. And I've saved a good portion of the lazy cash, right? Because I didn't have $180,000 outstanding in the beginning. I only had 60 or 70. And so by doing it that way, allocate. So I think there's one more of two ways to do it. One, you could allocate it so that it's all blasted out much more quickly, right? Or you do a lump sum initially and do it quickly. I know people are worried about like, oh, what about the cycle? What part of the cycle we're in? Is this a good idea? Um, all that stuff is not my business, right? How that works, how much you actually make on the Bitcoin investment is a separate discussion from how we're financing it and what's that costing us, right? And so I think there's a good chance that you could refinance, and even with new closing cost, a year from now, if you took out 75,000 this year, and then a year later, our rate's going to be lower. I think there's a decent chance. I'm never trying to bet on that. If they're not, and you take out a bigger loan again, even if it's at the same rate, at least you weren't paying the difference on the extra $100,000 for a year that you just sat on cash, right? I mean, at the end of the first year, you're still sitting on $120,000 in cash in this scenario. Um, that you're paying 7% for and only receiving 4% back, right? So you're losing 3% a year on that cash that we're just, there's not a really good reason for that. Now, and you could say, okay, well, we're paying closing costs again for the second loan. Um, and one, yes, I think that, and this is something that you could do some math around, but I think that the amount that you save here is probably enough to pay for those closing costs. If it's not, if your rate's gone down even a little bit, having because that loan, even though we're only looking at 3 years of, um, before you get fully allocated, you're still going to have that loan forever, right? So the savings of even like a half a point interest rate on the extra money is going to be tremendous. And then, uh, well, I mean, those are the main things, right? I mean, you're not paying for all this cash, because basically what you're doing when you take out a loan is you're renting cash, right? And if I'm only putting out $54,000 in the first year, but I'm renting 180,000, like it does, it doesn't make a whole lot of sense, right? Where we have access to that capital again in a year. Um, Now, and this is actually really supports the argument of, okay, take out the full amount, send it up, right, to the parent entity, which again is our Lofty account. So send it up to us, and let us figure out what to do with it to keep it active until it needs to be deployed, right? Like some people will just say, oh well, I'm just going to put it in a 4%, something that's giving me a 4% yield. Some people will put it to work making significantly more, and I would hope so. I mean, I'm never excited about 4%. It's perfectly fine, 3.5, 4, whatever, if it's the money that I have in cash that I need as a reserve. That's a business decision, right? Not really an investment decision. The amount that you have in reserves is like that's what keeps us from losing properties. And so, yeah, I don't think we ever really need to optimize the return on a reserve. But once we get past what a reasonable reserve is, then we really need to think about like what are we doing as far as that goes, right? Um, yeah, and so like I said before too, because we have this sort of dilutive debt on this, right? Because it really does just make, like in this particular instance, taking out a 7% loan to buy Bitcoin makes very little sense relative to selling the property, taking that cash and buying Bitcoin. And then maybe buying some Bitcoin and also reinvesting in another property that's a better yielding property, right? That you're actually getting some. I mean, this has been a nice stable yield. Like, this is why I owned it for a little while, although I've sold it one of the times that it popped in price. I actually like this asset a lot. Um, and I don't, and again, I don't have a problem with investing in Bitcoin. I just think doing it inside the entity makes very little sense. Taking out three times as much money as what you're going to invest in the first year also makes very little sense. Taking out a loan that's higher than, that the interest rate's higher than your cap rate. So versus selling again, I mean, none of those decisions, um, I think would hold up in a general, like, anybody who's worked with real estate investment companies and the way they look at deals. All three of those things make very little sense, and we're combining them here. So I don't know, and I know like this is a situation I think where I take a lot for granted, right? Like this structure to me, I learned about this actually when I was an undergrad working for an accountant. We had a whole bunch of real estate companies that worked for us. That's the first time I ever saw this. It's the very first lesson we learned in my real estate law class when I got to grad school, and it's something that I've learned several times since, right? Like that that the real estate itself is always one entity, one property, and just enough cash to operate. Anything else gets funneled up to the next level. And whether that next level is this parent holding company, whether it's multiple investors across the board. And I think what's confusing people is people think we're here and this is the DAO, but that's not how we're set up, right? Like if that were the case, we don't have anything protect, separating the property itself. Uh, and I can imagine someone's going to say, "Oh well, let's have the DAO set up a second LLC and move, it within the DAO and then move the property into that." I suppose you could do that, but then you still end up with these layers of risk. Um, for your and for your crypto that you don't have if you just keep it yourself, right? And the other thing, I don't even think I mentioned the Lofty risk, right? Like we've seen all sorts of different ways where they can slow down or impede or make decisions that affect us, and so like why I would want to hold my crypto in something they control, like, or have some control over, is beyond me, right? Like I just don't. It's hard to see the benefit to me, right? Like, when I can take that cash, we can all reinvest in it on our own. Same thing that you could do, and like there's just not. And then okay, all of us get together and pool our funds into the next deal, which we're already doing, right? We're already every time a new DAO property comes up, we're already buying those together. So it is. We're taking on a lot of new risk. we're adding a level of complexity where there doesn't need to be. And when you actually look at the the finance of the situation, we're not any better off than if that cash moved up. And again, I mean, this applies to this property. It applies to any of them that we're trying to make loans in this bottom entity. It applies to anything that we're doing here. Even when we're trying to do buybacks, if you really think about it, moving the cash up to this level would make a lot more sense, because then instead of just buying back the entity that happens to have more cash at the moment, you could do buybacks by you just buying the ones that are actually presenting the greatest value, right? Because when you do these share buybacks, the only reason they make sense is because you're buying the you're buying those tokens and burning them, but you're buying them at a price that's below the current value of the property. Well, unless you just happen to be in the DAO that has the lowest or the biggest discount, that's an inefficient use of capital. You should move it up here. Let the parent company figure out which one of these DAOs is actually the one where we should be doing it's not really a buyback in that situation, but you're just buying more of it, right? So there's all these things that we're trying to do at the DAO level that I think what when put under scrutiny just don't make a lot of sense, right? And so I don't know. That's obviously, you guys, is just my opinion. I don't mean to be like harsh about this, or I know I probably come off as a know-it-all all the time. And in this arena, I mean, I feel like I don't know it all, but this is like I mean, this type of thing is like breathing to me. Like, I've been doing this for 20 years. It is like, somebody comes in where they're trying to figure out, okay, how am I going to set up my deals? Like, this is the way you do it. Like, it's proven. It's worked for a long time. Unless I had a very compelling reason to want to deviate from this, it's hard to see where the benefit is. I would say, if you told me, oh, well, if we hold the crypto in the DAO, it's going to appreciate faster than if it's at the next level up, that would be a good reason. I don't think anybody thinks that. Um, do I think that the people that are running the DAO are going to make better investment decisions with the crypto than I'm going to on my own? Maybe that's true for me because, like, I'm not the crypto guy, but I think that a lot of you guys that are really into this probably don't think so, right? There's going to be times where you think the optimal decision is something different than what's actually being done. Um, maybe some of you like the idea that you won't have access to it, so it's just going to grow and you can't liquidate ever. And maybe there's some benefit to that. But you could set that up again at this level. And again, this level today for most people is just their Lofty account, right? If we're thinking about the DAOs, and whether or not you own your Lofty account in an LLC or you as an individual, it is, it's the next level up that's protected by the limited liability. I want my cash here. I want it. I want to get it out of the risk entities, right? And into and some people might think, oh, but this is a limited liability company. If it's in there, it's protected from me here, things that I do. And that's not true, right? Because my ownership in these can be taken from me uh, because of things that I do up here or above, right? And so it only that stop. It's like a one-way valve, right? It stops the end of the risk going this way, but these assets are all at risk from anything that I do, right? I mean, I can get sued, and unless I have proper asset protection, and there's which hopefully I feel like I do a pretty good job of that, um, but again, that's stuff that we can handle much better here than in the DAO. I mean, the other thing too is like, okay, if one, let's say it takes off and this DAO owns millions of dollars in crypto, that's all public information, much more so than if I own millions of dollars in crypto, which I don't, because that's not my main investment. Um, it'd be much more anonymous, right? If I just owned it directly, because somebody has KYC'd you to be in here, and you know, I don't know. So it's just really hard for me to understand. Um, if you've watched it this far and you don't hate me, even though you're a Bitcoin guy and I am, I think it's okay, but it's not my main thing. And again, like it's not none of this is saying that investing in Bitcoin is a bad investment. My whole point is the way that we're going about it is doesn't make sense. Doing it within this entity doesn't make sense. But if you've gotten this far and you think I'm missing something about what we're trying to do, please let me know because I'm super interested in. There's a bunch of people in this Discord that I think of as smart people that I think are rational thinkers, and so it's hard for me to see. I just don't see the benefit of it being done at this level versus being done up here, right? It's I don't know. So, and this is true for the purchasing Bitcoin. This is true for purchasing loans at that level. All of it, and I mean, the only real, the loans, some of it is I can have a little bit more control over the money in here, even though I don't own as much, and that's some of the loans back and forth. I think I can actually see at least the motivation. But for something that's just buying an asset that just is a couple clicks of the mouse and tapping on my computer and I can just buy it myself. It's really hard to see unless you think like, oh well, and then we're going to control it and we're going to get to direct it in the future. But it's you actually have more control over it if it's in yours and you decide which DAOs to buy in the future versus getting together with the DAO and trying to buy the next property. Anyway, I think I ranted about this much longer than usual. Maybe not too bad, but I do want to hear any of the reasons that you think that makes sense. If you think that there's some stuff that I'm missing about this particular proposal, or just in general about why we might want to do this, I'd really love to hear it. I did end up going and watching a whole bunch of videos and stuff about this, Bitcoin treasury companies, and I think that they can make a lot of sense, especially if you really believe in Bitcoin. Um, but again, I think that where your treasury is held in a structure like this is typically here. It's not down here. And so and like I said, I mean, I didn't just make this up either. Like you can find, I've literally seen hundreds of these charts because it's every professional real estate investment entity out there. I mean, they're almost all set up this way. Sometimes this might be a series LLC, sometimes it's a limited partnership with a corporation, a C corp as the general partner. So I mean, there's all these different structures, but there's the general shape of them is always the same. Nobody's ever in these entities trying to make loans, trying to buy other assets. I mean, it just doesn't happen down here and there's good reason for it. All right. I think I've said that probably 17 different ways. So until next time, I'm going to keep obsessing about risk so that you don't have to, but you should think about it a little bit. So go ahead and do that.